Hedge funds are pools of money that get managed with a lot of freedom about what they do. So contrary to mutual funds, who are very constrained about what they do, hedge funds can do anything. So for academics, it's kind of exciting because they really try to implement sophisticated strategies as opposed to doing very simple stuff. Hedge funds are definitely among the people who consume the most sophisticated tools and recent research from the academic literature. So that's why there is this linkage between academics and hedge funds that is pretty strong. We look for stock anomalies, like situations where it looks like if you invest in a stock, you make money. What my paper does is say, hey, it's important to know whether you can actually put a lot of money at work there or just a little bit. If it's just a little bit, it's not very interesting from an industry perspective. And so the paper tries to calibrate whether you can put a lot of money behind a certain strategy or not. That's really what we are doing. When you trade on markets, you move prices against you. For example, if you find a very small stock which you believe is like mispriced, for example, let's say it's very cheap today, if you're a big fund, probably there is not a lot of money to make there because by investing in that stock, you are going to push prices back to normal very quickly. So in fact, you are going to lose money probably by trading. So basically, hedge funds are looking for strategies where you can put, billions, tens of billions, sometimes hundreds of billions at work without, destroying your own strategy. Each time you trade, you shoot in your own feet. It's unavoidable. But the question is, what kind of strategies are needed to avoid these negative effects of trading? So what we find is that there are two things that matter for having strategies that are scalable. One is the liquidity of the pool of stocks that you are trading, and the second one is the persistence of your signal, meaning I find that a stock today is cheap. Does it mean that in a month from now, maybe 3 months from now, it will still be cheap? If yes, it means I have a lot of time to enter the position. I can take 3 months to enter. That's a strategy where there will be a lot of room. If I have only 1 hour or even 1 minute to enter, obviously it's a very, very small opportunity, because I won't be able to push a lot of money there. So one big topic today in the industry is the capacity. Let's say you run a fund and you have like 10 billion. Is it too much for your own sake or not? So investors ask more and more this question. Hey guys, you have become big. Isn't it going to make performance smaller and weaker, and shouldn't you guys stop accepting money? And so the paper gives a precise answer to that, meaning if you trade a given strategy, how much money can you accept without, making the performance too weak for your own investors? Basically, trading means you burn energy. Each time if you start to trade large quantities, you will leave money on the table and probably more and more money. So the question is, how big can you be without becoming too big to basically be flexible? So I think this kind of conference is very important to get a sense of what are the new problematics that the industry is working on and academics are working on, and really trying to link them. On paper, financial markets are not that complex. In a textbook view of financial market, prices are set and not much happens. There is no profit to make. That's the no free lunch world, of the textbook efficient market hypothesis. In practice, it's not the way it is. There are a lot of frictions, trading is costly, information doesn't flow, some people have more information than others. And so it's very important to get a sense of what is the current market structure, what are the new trends, to be able to address problems that are relevant and not imaginary.